Right then, I think we should get started. Good afternoon, and many thanks for joining this Alquity webinar, part of our series that updates you on the investment views across our strategy range. I will provide a short introduction, and then we will leap straight in. If you have a question to ask, please use the question facility. I suspect you're all experts on this now. Or you can send me a direct message. I will compile them together and make sure they're all answered. I anticipate that we will all be done in 45 minutes, though we can allow more time if needed. And today we are focusing on Asian markets, and the title is A Clear Path Out of the Storm. So what is the storm that we're talking about? Well, firstly, the path of global reflation post-COVID-19 has seen markets perform very well, and Asia has relatively led the way, both in economic terms, but also in stock market terms. With the shock of another COVID wave in India, has this possibly been put at risk? Second, the outperformance of the region itself, in a relative sense, peaked in mid-February, even before recent events. What can help resume and maintain this outperformance looking forward? Third, the US dollar has been weakening for almost a year until mid-Feb. This is historically a strong boost to EM fortunes, but this trend turned about face abruptly until this month. Should this be a concern to investors? Fourth, and nearly last, lower valuations have been an encouragement to investors seeking value. Did we see that relative value dissipate, and can Asia grow fast enough to justify being a long-term value play into the foreseeable future? And lastly, the oil price. Having been as low as $10 in March last year to stabilizing at $40 through last summer, it is now at over $60. What does this mean for the region and the markets within? So we have a number of the team presenting today to cover this and more. I would now like to hand over to Dan Billis, who will start proceedings. Dan.
Thank you, Alex, and thank you everyone for taking the time today. I hope you enjoy the presentation. For those of you who might not have met me before, my name is Dan Billis, and I'm the Senior Investment Analyst at Alquity. Speaking today, we have Mike Sell, who is our Head of Global Emerging Markets Equities. Mike has over 25 years investing experience in emerging markets and has been with the company since 2014. Also joining us today, we have my colleagues Kiran Kader, who is our Associate Portfolio Manager, and Gergely Ulmozy, who is our Global Macro and Portfolio Strategist. So if we take a look at the agenda on the next slide, there are going to be three main areas that we're going to be discussing today. Firstly, we'll take a look at the last 12 months of Asian performance, and also go into a bit more detail on the recent market pullback in 2021 and go through some of the reasons for that. Next, we'll take a top-down overview of the Asian region, and we'll explain why we think Asia still remains one of the biggest unrecognized opportunities in global markets today. And finally, we will explore in a bit more depth some of the more attractive areas within our portfolio, and also some of the themes that our portfolio companies will benefit from in the coming years. So starting off with performance, on the next slide, you can see here the pink line represents the Alquity Asia Fund, and the grey line underneath represents the MSCI Asia Index. Now, for those of you who might not know, we added a new head of risk called Mana Yui, and we actually implemented a number of enhancements to our investment process in Q1 of 2020 with respect to portfolio construction and risk management. So I'm very pleased to share some of the Citywire UK performance characteristics you can see there on the right. For returns, we came top of the second quartile, standard deviation, top quartile, and max drawdown, top of the second quartile. So although it's only been a year, which is quite a short horizon in investing terms, I'm very pleased to say that we have been so far delivering on our goal of a much more stable and robust returns profile for the fund. Now, if we take a look at the next slide, we can see the recent outperformance in 2021 has actually reduced, and we've seen a bit of a market pullback. So what are some of the reasons for this? We have identified 3 key reasons that we would point to for this pullback. All 3 reasons we would say are short-term, transitory in nature, that will eventually fade over time. So firstly, longer dated yields in the US Treasury markets actually rose very sharply in February to March. Now, this was partly driven by the second point on the list, namely inflationary fears, but also at the time, there was a number of concerns related to regulatory intervention. And such an abrupt increase in US Treasuries typically worsens global investor sentiment and also the performance of riskier assets, such as emerging market equities. However, so far, our thesis regarding the temporary nature of a spike in yields has been proven to be correct, and we're sticking to this view. Gerge will, in later slides, go on to explore this in a bit more depth. Secondly, inflation expectations actually rose in February to March of this year. Now, not only is this much more relevant for developed markets than it is for emerging markets, we would say that fears concerning a spike in inflation that could last for a very long time are actually fundamentally unjustified. And currently, we see very little evidence that would actually support this quite hawkish thesis. And finally, on coronavirus, unfortunately, coronavirus is spreading in a number of Asian countries, and the spread is getting a bit more severe. And some market participants have quite rationally taken the view that this will lead to further lockdowns, which will then lead to a very negative economic impact. However, the view that they take, we would say, is far, far too negative. And in fact, many participants are actually forecasting a very over-exaggerated economic impact view. However, we would say that many Asian markets are actually pricing in a scenario with a severe economic fallout and have very much underappreciated the progress with the vaccinations and a very strong vaccine rollout across the region. So in sum, we would say that the long-term potential of emerging Asia is unbroken, and that performance this year will reignite. And with that, I'll pass it over to my colleague, Gerge, to explore the macro in a bit more depth.
Thank you, Dan. If we can turn to the next slide, please. The chart shows the real GDP growth difference between emerging Asia and G7 countries. The red line denotes GDP growth in EM Asia, the blue line in G7, and the gray area is the difference between the two. Real GDP growth in emerging Asia has been historically stronger than in G7 countries. This was also the case during the COVID crisis in 2020, when EM Asian economies proved to be more resilient than developed ones. Despite the most recent unfavorable news flow regarding the spread of the coronavirus, it will not lead to significantly stricter lockdown measures, in our opinion. As a result, the synchronized economic recovery can carry on globally in 2021. Such a synchronized upcycle has been historically positive for Asian economies as well as for their financial markets. Therefore, we believe faster growth in Asia will boost markets in the coming quarters. Turning to the next slide, one of the root causes for the loss in Asian stock market momentum was the steepening of the US Treasury curve. This phenomenon is captured by the chart on the left, where the Fed funds rate is denoted by the blue line, the 10-year Treasury yield is displayed by the green line, and the gray shaded area represents the forward-looking real yield. The abrupt and sharp increase in the 10-year yield in February and March compressed negative real interest rates, as well as triggered the appreciation of the US dollar against emerging currencies. The chart on the right exhibits the US dollar's performance against a basket of EM currencies. The unexpected rise in longer-dated Treasury yields in February and March was mainly attributable to the revival of inflation expectations and uncertainties regarding banks' capital requirements. We held the view at the time that the tightening of financial conditions, including the dollar rally, was misplaced, and our thesis has proven to be correct. Therefore, the headwinds brought about by higher yields and a stronger dollar were temporary in nature and have been reversing since the beginning of April. As inflation expectations remain contained and the Fed maintains its ultra-dovish stance, negative real interest rates will continue to hover around historically deep levels, which in turn will serve as a very strong argument against higher yields and a stronger dollar. Now, turning to slide 9, despite the tailwinds, such as the expected GDP growth outperformance and historically wide negative real interest rates in the US, emerging Asian markets still face a hurdle, which is the spread of COVID. In our view, this headwind should not last much longer, as the inoculation drive has been gaining significant momentum in emerging Asia, as evidenced by the chart. The chart shows that the number of vaccines administered per 100,000 people at the end of January, February, March, and April in the Philippines, South Korea, Indonesia, India, and China in comparison with the global average. It was reported this morning that almost 230 million doses were administered in China, which translates to about 16.5% in proportion of the total population. This number is almost 11% in India and over 7% in Indonesia, which compared to the global average of 14%. Therefore, we hold the view that the market's attention will shift over time from the spread of COVID to the progress made with the vaccination. Let's turn to slide 10 now. Valuations have become highly supportive of emerging Asian equities. Again, as the chart on the top shows, the trailing price to book value of the MSCI All Country Asia ex-Japan index has reversed to its 20-year historical average. The chart on the bottom captures the same index's relative valuation to the MSCI World Index, which has returned to compelling levels. In our view, valuations are mainly reflective of COVID worries, and they are not factoring in the favorable GDP growth outlook for emerging Asia, nor the tailwinds provided by the more stable US interest rate and Treasury yield environment. I now hand over to Mike to talk about the portfolio in more detail.
Thank you, Gege. On the next slide, you can see the two main themes in our portfolio. Firstly, domestic structural growth. And this has been a core part of our portfolio since day one, and we have very significant exposure here. So companies that benefit from urbanization, demographics, in some of the more emerging markets, the shift from the unorganized to the organized economy. And in some of the more mature markets, the consumption upgrade cycle, the rise of the middle class, if you will. Also, the shift from the offline to the online economy. And this domestic part of the portfolio represents around 75% of the Asian fund. The balance of the portfolio is comprised of globally focused companies with long-term sustainable competitive advantage. This is predominantly tech hardware, companies such as Taiwan Semi, SK Hynix, as well as smaller companies such as Lino in Korea. It isn't entirely tech-focused. Companies such as Pacific Basin or Wuxi Aptec in the cyclical and the healthcare space also would be examples of this. And this global part of the portfolio is around 25% of the fund. Now, on the next slide, you can see our asset allocation and our top 10 holdings. China is the largest part of the portfolio, and the biggest stocks within that are internet names, and Kieran will spend some time talking about that in a moment. Also within there, we have a number of consumer names, and we've actually been increasing our risk in China following our positive macro view that Gerge has just been talking about, and added Sunny Optical, which is a lens manufacturer for smartphones, just last week. In contrast, we've been de-risking our Indian portfolio over the last 4 weeks as we saw the rise of COVID cases pick up. This is only a very short-term temporary move, and the next move as we sit here today is to add back to those positions. Elsewhere, in Taiwan and Korea, we have less in these markets than many of our peers, and our positions in these two areas are balanced more between the domestic names and also those globally competitive names that I mentioned previously. Then the rest of the portfolio is one of our key differentiators, made up of smaller markets such as Indonesia, the Philippines, and frontier markets such as Vietnam, Pakistan, Bangladesh. We added a further name to Vietnam in the last week, VP Bank, and so the weighting there has increased, and we're waiting for a really exciting tech IPO in Pakistan for that weighting to increase as well in the coming weeks. On the right-hand side, you can see our major positions. We have Taiwan Semi and Tencent as two of our largest positions, and we make no apology for being very similar to our peers in this respect. These are good companies with good ESG that continue to grow and dominate their spaces. However, the rest of the top 10 look very, very different to any and all of our peers. Names such as SK Hynix in Korea, Ultratech Cement in India, Delta, which is a Taiwanese hardware company. They produce components, both power supplies and also industrial automation. And they're very focused on energy saving equipment. So this company has a real impact in terms of meeting declining GHG emission targets as well. Then we have SEA and Kakao, which are internet focused companies. Kakao we added to the portfolio 12 months ago in the COVID sell-off, and it's something that's been a very strong performer since. And then we have Yongda Auto, which is a car dealership in China, and Pacific Basin Shipping, which also is a Chinese company, and we'll spend some more time talking about that in a moment. I'll now pass on to Kieran to go into a bit more of a deep dive on the internet companies in China. Over to you, Kieran.
Thanks, Mike. So on the next slide, for Chinese internet companies, regulation has been at the forefront of investors' minds, and the sector has derated by approximately 20% from the peak to today. We believe that those concerns are warranted, but it's worth noting that the sector has been under-regulated for many years. Beijing had promoted technological innovation as an important driver of economic growth, and this to a large degree has been successful. But now, policymakers are concerned with anti-monopoly behavior, as well as any related systemic risk. So we believe that implementing rules today ultimately leads to a more sustainable growth in the future. Alibaba is perhaps the most prominent example of this, where the regulator imposed a record fine of $2.8 billion for abusing its dominant position. And it's worth noting that we had failed Alibaba on ESG reasons due to the very weak governance structure. But interestingly, regulators are taking a softer approach with other tech companies. They've been given a 1-month amnesty to rectify any problems in their own operations. And we believe that this self-regulation approach should alleviate some concerns in the sector. And we remain confident in our positions and ultimately believe that the fundamentals remain strong, even in a post-COVID world. Our holding Meituan-Dianping, which is a food delivery app, has seen sustained sales growth even post-lockdowns, as you can see on the chart on the top right. And another holding, is Tencent Music Entertainment, which is an online music streamer similar to Spotify. And looking at the graph on the bottom right, the green line represents Spotify's percentage of paying customers, which is steady at around 45%. And the pink line is Tencent Music, and this has just less than a 10% paying customer ratio. So this represents a really powerful monetization opportunity. And in addition, investor demand remains very strong. Secondary listings in Hong Kong have been well supported, and Meituan has also very comfortably raised $7 billion in the last few weeks. So our view is that quality names will continue to shine, and we hold positive outlooks for these investments. Back to Mike.
Thanks, Kieran. On the next slide, you can see Pacific Basin, which is a Chinese shipping company that I alluded to a moment ago. It's important to note that our Chinese portfolio isn't just consumer and internet. We are able to find cyclical opportunities as well. The chart on the left shows the demand and supply for minor bulk. By this is things like grains and logs. And the dark blue line is demand, and the light blue line is supply of ships. Perhaps unsurprisingly, given our view on the global economy, we've seen a sharp bounce in demand over this year, driven by the US, by China, and generally global growth, reaching 4.8% year-on-year growth. And that's expected to remain firm next year as well. But perhaps more interestingly, the supply of ships continues to decline. Now, this is a highly cyclical industry anyway, but the International Maritime Organization has specified emission standards for new ships. And unfortunately, the technology to meet these standards doesn't yet exist. Therefore, unsurprisingly, ship purchasers are not buying new ships until this technology is commercialized. Therefore, we're seeing very strong demand and very little supply. And this is something that we identified some months ago when we initiated the position. Unsurprisingly, the chart on the right shows explosive growth in bulk shipping rates, the red line at the top, so far this year. This is one of the strongest performances for actually almost a decade, and is doing very well for Pacific Basin, which we rate an A in our ESG process. Now, sticking with ESG on the next slide, we've spent some time talking about China. And as many of you know, ESG goes to the absolute core of everything we do and everything we have done at Alquity for a decade. And is there a contradiction between being an ESG investor and investing in China, given many of the controversies that we know that exist in that market? So for us, there are 703 potential Chinese companies listed in Hong Kong that meet our long-term themes. But through our screening process, we fail 37.4% of those for ESG reasons, such as being a state-owned or state-linked company like China Mobile. We won't own those as they're not running the interest of minority shareholders. If there are pollution incidents, product quality issues, poor treatment of workers, corruption, conflicts of interest, we rule these companies out, as well as if they don't meet any of our red flags. So tobacco, spirits, gambling, the oil and gas, coal, these are all ruled out. And we've actually enhanced this further over recent months by adding red flags relating to animal testing, palm oil, fishing as well. So having screened out a large number of companies, we then do our deep dive and assign an internal ESG rating of A, B, C, or fail to every company. So Alibaba has always been a fail for us due to numerous concerns since day one. Following that, we also undertake extensive engagement and monitoring of our key progress indicators, and I'll go into a little bit more detail on that in a moment. But it's worth sharing, perhaps surprisingly, that Hong Kong listed companies now provide some of the best in class disclosure on E, environmental, and S, social issues. It's a requirement of the Hong Kong Stock Exchange. And so many of the misperceptions about China are that the disclosure has got much better and is much, much better than, for example, India. So we're confident that having undertaken an ESG process in Asia for 7 years since the launch of the fund, we're very good at screening out and removing companies that do have ESG issues, and the proof of the pudding has been our experience over that time. But in any case, our portfolio naturally focuses on lower risk areas: internet, insurance, consumer names. These are not the areas that typically have the problems that we read about in terms of Xinjiang, labor issues, pollution. So we're confident that China being the largest part of our portfolio, the ESG standards are just as high, if not higher, than we see elsewhere in the portfolio. So now moving away from China, I'll let Kieran spend a little bit of time talking about India.
Thanks, Mike. So India has been one of the best performing markets over the last 12 months. And we believe that India still represents one of the best opportunities in Asia. However, we completely acknowledge that the COVID resurgence is a new risk and one that simply cannot be ignored. The news flow is overwhelming. We're seeing daily cases in excess of 300,000 per day. The optics are perhaps slightly challenging. As a percentage of the population, the per capita cases are still lower than places like the EU. But of course, we are completely open to the possibility of this changing and that this figure could be underreported. This is not unimportant, but there are other significant factors to consider. Firstly, Prime Minister Modi has stated that the central government will do everything that they can to avoid a national lockdown. The economic costs of last year's lockdowns were painful and thus have learnt from history. Secondly, as Gerge mentioned, the inoculation drive carries on rapidly with a staggering 2.6 million vaccinations per week, reaching a total number of 141 million people inoculated by Monday. This is no small feat for a large country like India. And lastly, the overall death rate remains low. Current estimates show that the mortality rate is around 1%. So COVID is a risk, but it's a risk that is not insurmountable and does not damage the structural growth opportunities that we focus on. And some of these include infrastructure spend, which is set to increase by 34%. And this benefits our holdings in cement. As you can see on the bottom chart on the bottom right, the year-on-year cement price growth has remained positive for many months. In addition, the next monsoon is predicted to be very good, and that would be 3 good monsoons in a row. And this is extremely positive for our exposures in the rural economy. So all in all, there is no change to our thesis. In terms of this year's GDP expectations, we went from 9% to 11% as the bounce back was faster than expected. And that's been revised down to 10% due to the local partial lockdowns. However, a 10% recovery from last year is still a V-shaped recovery. In addition, we have acknowledged the increase in short-term risks and have accordingly tilted the portfolio, having reduced risk twice in the very near term already, but we remain deeply confident on the positive fundamentals. And on the next slide, I'm going to talk about Century Iron and Steel, a stock in our third largest market, Taiwan. Century Iron benefits from 2 of our themes: decarbonization, which is a form of monetizable structural growth, and sustainable competitive advantage. Century Iron are the manufacturer of the pins and jackets for offshore wind towers. You can see the diagram on the screen, and that's the bit at the bottom of the diagram that they make. And they'll start to fabricate their towers in 2022 in conjunction with a very reputable Danish company. Now, the structural growth opportunity for decarbonization in Taiwan is extremely clear and exciting. Taiwan targets 50% lower carbon emissions by 2050 and also plans 5.5 gigawatts of offshore wind energy by 2025, with an additional 10 gigawatts by 2035. This is also really early days for Taiwan. The first commercial project only started in 2017, and that gives you a sense of how large the potential opportunity remains. In addition, there are huge barriers to entry. This is simply a challenging market to get into, and that translates to limited competition from both domestic and overseas competitors. And lastly, this provides us with positive decarbonisation impact characteristics for the portfolio. And this is a theme that we are excited to develop more so in the coming months. And on the next slide, please, Alex. Another core part of our portfolios is the exposure to the Indonesian consumer. And this is a really differentiated position versus our peer group. Unfortunately, Indonesia has not been immune to a second wave of COVID, but it's encouraging to see the recovery from this set of lockdowns. In particular, retail and recreation has seen a reasonable bounce, as indicated by survey data and the Google Mobility Index. And this is naturally really positive for the near term. However, we still think that the mid to long-term structural growth opportunities are very underappreciated. The graph on the right-hand side shows that the population growth for the affluent and the established middle class is expected to grow at around 7 to 8% for the next 10 years. And this rapid shift towards the middle class presents a really exciting multi-year opportunity, and this shift fuels our investments. So for example, Nippon Indosari is a bread producer and bakery with 90% market share in the mass market. But Nippon is really benefiting from the premiumization trends due to higher disposable incomes and rising living standards. Sari Melati is the Pizza Hut franchise operator with 97% market share in pizza restaurants. And this is benefiting from the overall trend of increased dining out. And lastly, Kino is a producer of niche products in the personal care, beverage, and food space, where Kino dominates in their respective niches. They are also benefiting from the upgrading of living standards. So that was a snapshot of some of our themes in the portfolio. Handing it back to Mike for our portfolio characteristics.
Thanks, Kieran. So bringing this together on slide number 19, I just want to highlight some of the differentiations and some of the themes that we've been talking about. The portfolio focuses on these long-term themes: domestic structural growth, companies with sustainable competitive advantage, and the domestic part of the portfolio is the largest part, as I explained earlier. Following the risk work with money, we have risk-controlled exposure to small cap stocks. 46% of the fund has a market cap of below 10 billion. That's about 30% more than the index, but we've constructed the portfolio in a way that, as you've seen, delivers more consistent returns and isn't purely dominated by that small cap effect. We also provide exposure more than most to frontier markets and the smaller markets where we find really exciting opportunities such as Indonesia and the Philippines. On the right-hand side at the top, you can see some of the portfolio characteristics. Our fund is typically cheaper than that of the index. You'll see a slightly skewy number there from Bloomberg, which is accurate, but the point stands, and we have a higher ROE. Our ESG process means we own quality companies that are trading cheaper than that of the index. At the bottom right, you can see we have 54 positions in the fund, an active share of over 80%, and a turnover of below 15% on an annualized basis. Now, on the next slide, I'd like to share some of our engagement priorities for this year with you. We produced a thought piece at the end of last year about the environmental impact of the internet. And we mustn't forget that many internet companies in China are powered by the grid, which unfortunately is largely coal-based. So we are engaging with our companies for greater use of themselves to use renewable energy. And it was encouraging that the recent article by Greenpeace highlighted that Tencent was actually the best at this and Alibaba was actually the worst at this, which ties in with our own findings in that report. We also are engaging on the treatment of workers in the gig economy, such as with Meituan Dianping and SEA. Secondly, following the thought piece on the protein food supply chain that we published earlier this year, we're engaging about traceability with companies such as Pizza Hut Indonesia. This is important not just to maintain quality of the products, but to ensure that their suppliers are not overusing antibiotics, that the feed for the livestock is not coming from areas that are being deforested, and we want to obviously ensure companies support biodiversity. And we're looking at increasing our key to include some of these metrics as well. And then at a China-specific level, we're engaging with companies to move in line with President Xi's environmental targets to reduce their greenhouse gas emissions. And whilst, as I mentioned, Hong Kong listed companies are very good at publishing GHG data, more so than elsewhere in Asia, we're pushing them to publish Scope 3 data as well as Scope 1 and 2. But what we are seeing is that cross-company comparisons are now possible in terms of GHG, water, waste, as this is all now published in Hong Kong, which is something that we'd like to see throughout the region. Finally, concluding on to the next slide. We're experienced ESG investors, and that's absolutely critical. We've been doing this for a decade. ESG is something that you learn by doing. You can't just bolt on an ESG process to an existing emerging process. And our portfolios provide tangible impact, not just through some of the names that we own, like Delta or Century Iron and Steel, but more importantly, through the Alquity Foundation and the 10% of our revenue that we donate to support enterprises and projects in the areas that we invest in that really have a meaningful impact on people's lives. The process enhancements have delivered better and more consistent returns. We've outperformed 9 over the last 12 months in the Asian funds, and that is something that really enhances our attractiveness versus our ESG process and our really good abilities of picking stocks and countries that have always been there. The portfolio is highly differentiated in terms of frontiers, small markets, themes, and small cap names. And as Gergely said, the headwinds are dissipating and the global macro environment is supportive for Asia. The valuations are looking attractive. And so we would argue that this is potentially an attractive entry point to increase weightings into Asia. So I'll stop there and hand over to Alex for Q&A.
Thanks, Mike. If I can just leave it on the conclusion, I think that's probably more useful than the picture of the Hong Kong harbour. So there's a number of questions. I think some of these questions came in before your conclusion, so there's a link. So forgive me if you feel, Mike or Gergely, probably that you're going over old ground. But the question is that clearly we've had global growth and there's been a reflation, which has led to Asian growth. COVID, you've explained a bit about, especially in relation to India. But can you explain a bit more about why you believe India can come out of this quite well as one of the major countries in the region, but also what the effects are of COVID across the rest of the region, because there's very little information. Not sure if that's you, Mike, or Gergely.
Sure. I'll tackle India and I'll let Gergely talk about the impact elsewhere in Asia. So in India, there's 3 aspects to this that we must think about. Firstly, there's the absolutely awful headlines, which we've seen particularly over the last week. Secondly, there's the impact on the economy. And then thirdly, there's the impact on the market. So whether the cases are peaking or when they will peak, no one's quite clear. My view would be that we are nearer the end than the beginning, but we're certainly not at the peak just yet. And so we're going to continue to see challenging headlines in India over the coming weeks, though the worst is probably past in terms of the shock value. In terms of the economy, the Asian Development Bank came out with an assumption of 11% GDP growth for India just today. We would think it'd be slightly less than that, but it will still be one of the strongest bounce backs in Asia. Slightly tapered by what's going on with COVID now, but not dramatically so. So the economy continues to power ahead, and India is living with COVID rather than going for a severe lockdown, as Kieran mentioned. And then in terms of the market, as we've seen with European markets, with the Brazilian market, India is very much looking through this. The progress, as Gergely talked about in vaccines, means that there absolutely is light at the end of the tunnel. So this second wave in India has been absolutely brutal. but that isn't causing a sell-off that we saw last year. And we've positioned the portfolio accordingly for this, reducing the risk down in a couple of stages earlier on in this month itself. So as I mentioned, the next move will be to increase that risk back in the coming days and weeks. And I'll pass on to Gergely to talk about the impact of COVID throughout elsewhere in Asia.
Thank you, Mike. I think it's fair to say that it's very difficult to come up with a general answer to the region. It's country by country. Each government and policymaker is aiming to balance out the economic costs with the health-related costs. So it's a very difficult situation they are in. But what makes this crisis different to the crisis we've seen around the 2007 and 8 during the GFC is that this time both governments and central banks in most countries reacted quickly and efficiently and delivered stimulus measures that are supporting the economies. Just to give you an example, Vietnam is still growing fast, and it was one of the very few countries in 2020 which managed to register positive real GDP growth despite the temporary lockdowns at the beginning of the year and despite shutting their borders from tourists. Another positive example is Taiwan, which has been relying on a very strong export numbers, and it's been steaming ahead quite quickly. Other countries have different approaches. For example, in Indonesia and the Philippines, as the virus is still spreading, governments opted for a longer period of lockdowns, which delayed the cyclical upswing. But again, as in Indonesia and the Philippines, the vaccination drive is going ahead. Central banks are keeping their interest rates at historically low levels, and the governments stand ready to provide additional fiscal support. The overall outlook is going to improve over time as the inoculation drive proceeds and progresses.
Thanks to you both. Look, there's a limited number of time, so I'll ask you for very short answers to a couple more macro questions, and then we'll look at some country-specific and sectorial questions. So we've got growth in the region. I think we've established that. Is inflation a problem in Asia? I know we tackled this in a previous note, but what do we feel about it now?
Inflation structurally is going to remain low this year and next year, so we might see some temporary acceleration in some countries, but it's not going to be meaningful enough to cause any market movement that could last. And central banks have expressed that they are not going to reverse their dovish stances just because temporary increase in inflation.
Very good. And one of Mike's favorite questions, though I think it's for you, Gergely. The oil price I mentioned at the beginning. So someone's asked, is the oil price an issue, I guess, particularly for India at $60?
Oil price is an important driver for both the economy and the markets in Asia. So most Asian countries are net importers of oil, but at this point, I would say that the impact would be minor on growth, inflation, and the current account. So I believe our view is that crude oil price is most likely to remain broadly stable in the next 3 to 6 months, as the OPEC Plus intends to be mindful of the supply-demand dynamics in the crude oil market.
Okay, very good. So some sectorial questions. How do we feel the ESG environment in China is developing? And I guess you could link that into some of the stories around Alibaba and Meituan Jianping, but maybe more widely about how you can access good ESG.
Yeah, it's mixed, I think, is the answer. So when it comes to the Shanghai listed A shares, it's difficult. There's very little transparency and there's not ESG reporting. And we have only one position there. With the Hong Kong companies, it's absolutely getting better. We've gone from no disclosure to some disclosure. Now we're able to make those cross-company comparisons. Unfortunately, many companies are calculating things in different ways, and so that's a challenge, but we're definitely seeing improvements. In terms of governance, it remains a problem in many areas. We fail a huge number of companies for governance failings. And so I think in the interest of time, it's mixed. It's a stock pickers market, and you have to have a strong, robust process and plenty of experience, which I'm pleased to say we do.
Okay, thank you. Question related mainly to Taiwan, but 5G as well. There seems to be a global shortage of semiconductors, and that must have benefited TSMC and others. Do we feel that's likely to continue, or what will make that alleviate? And is it a good thing to alleviate? I guess we'd like it to be a problem, given our positions.
Kieran's our expert there. So Kieran, would you answer that one, please?
Sure. So I think the question was absolutely right. This has absolutely benefited TSMC and with a number of other holdings as well in the semiconductor hardware space. I mean, the latest commentary, at least, has been, for the next 1 to 2 years, we will see some shortages in semiconductors. Historically, Taiwanese foundries that produce these goods, they haven't added capex very quickly for fear that the cycle will turn against them when the demand becomes low, and therefore they would be in an oversupply situation. So that's kind of the genesis of where we are. The supply was okay for up until sort of the start of 2020. 2020 rocked everything as a result of the pandemic, and we saw a huge increase in the demand for semiconductors, from notebooks to servers to washing machines. It really impacts everything. So yes, the answer is we will continue to see shortages probably for the next 1 to 2 years. This will benefit the hardware manufacturers, but other industries such as the automakers, they will see some struggles. That is somewhat difficult to alleviate, because to build up capex, to build up capacity even, takes some time. So we're looking at a time frame of between 1 and 2 years for semiconductor supply shortage.
Okay, last 2 questions. We have the majority of the audience still here, so I'm guessing they haven't voted yet with their feet to leave. But a question just come in. It says, your cement pick in India, is the company in the right region where a lot of restructure happens? And there are long distances for cement transport. Does that mean high transport costs? And then the 3rd question, I guess, they're possibly linked. What about the rupee, I guess, in terms of US dollar? So 3 questions. It's about cement, about, has it got good prospects, I guess? Is it high transport costs? And what are the ramifications? And what about the rupee?
So Kieran, one of yours again.
Hi, Alex. Sorry, I got the first 2 bits. So, sorry, do you mind just repeating the
Talk to us about cement in India, the costs and the benefits.
Yes,
And then second, can we talk about the rupee? I guess that's Gurgay versus US dollar. Yes. So I think the first point to make is that, as mentioned before, the infrastructure budget has been very favourable for the cement players. This started a while ago. We've seen that the price increases that the cement producers have been able to make have been year-on-year positives. So that tells you something about the supply-demand dynamics. As to whether the companies that we hold are in the right areas, our main company is Ultratech, which is a pan-India player. It's the largest by capacity, and they have a lot of resources across the whole country to sort of meet the demands of the region, of the whole region. And we have another company, which is Heidelberg Cement, which focuses more on sort of Central East region, which is also an area where there's particularly strong demand for cement. The only region that generally has supply demand issues is in the south, so we're not too exposed there. In terms of transportation costs, again, they're absolutely right. This is true. They're fairly high for cement players, and that's why you need to have very good distribution networks. Ultratech has probably one of the best, if not the best, in India, and you can see that in their transportation costs as a percentage of sales is relatively low versus their peers. And also, I guess I'm not sure if the question was more on the rupee or
oil perhaps in general. The input cost for transportation costs is naturally oil or oil linked. But as a result of the ability to increase prices for the product, they can manage their margins. So their margins are protected given the demand supply balance, even though the oil prices are going up.
Great, thanks, Kieran. So look, I think it's about time to wrap up. If you didn't get a question answered the way you wanted it to be, or you've got more, please feel free to send to me or to one of your other contacts at Alquity. Before we go, Mike, on the spot, I know it's not as simple as this. Top 3 country picks in Asia. 1, 2, 3, go.
On what time frame, Alex?
6 months.
India, China, Vietnam.
Great. So thanks very much, everyone. We'll leave it there. Hope you can join us on the next webinar. Many thanks for participating.